Okay, let's answer some questions from the January 8th market outlook. This first question had some preamble to it, which I think we can skip and we could just go right to the question. The way I see it, lower unemployment rate than expected has negative implications for inflation, which means more likelihood of higher rates for longer from the Fed. This would likely cause the market to plummet. However, because about 90 to 95% of the job gains, 100%, were part time, and a good catch on the level of education, I had not thought of looking at that metric, then we can infer that inflationary pressures from the lower than expected unemployment rate won't be as bad as if all the job gains were full time. If a market is looking for any reason to rally, wouldn't that in itself be sufficient? Sort of a silver lining. You can look at it that way. You can say, well, listen, the market is simply just responding with a way to avoid inflation. Much like we can go to the grocery store and we can experience whatever inflation rate we want by the mix of things we put in our basket. So if fresh vegetables become too expensive, well, okay, well, we don't have to have that this time. We can get our vitamin content from something else. So you can do that. You can say, well, look, my grocery bill is the same month over month over month. I have no inflation. And the answer would be true, but the quality of what's in your basket is lower each and every time. So it's one way of thinking about beating inflation by lowering the quality and the quantity of the things that you want. If you look at your basket and I say to you, do you really want that stuff? You might say, no, I would rather have this other stuff, but I'm trying to make sure that my grocery bill is $100 a month, and that would put me at $120 a month. Well, okay, so that means there's still food inflation. As we measure inflation, because remember, inflation is the average over the economy. It is not your inflation rate. You have a choice. You can live way above the level of inflation or way below the level of inflation because you have choice. That is what the PCE does for us, the personal consumption expenditure. It does make choices. It does make substitutions. That's why the Fed looks at that when it's a better gauge of general price pressure that's faced on average in the economy. Employers have the same choice when they hire. They can say, well, I can hire a full-time person, but golly gee, it's so expensive that if I hire two part-time people instead, I don't have to give them benefits. I don't have to give them paid time off. They don't get paid holidays, those 10 free days every year where you got to pay people, and I can pay them less per hour. If you ask the business, do you really want to do that? The answer might be, no, I don't, but I simply can't afford these other people, which means the underlying wage inflation in the economy is still very high, and they're doing what they can to adapt to that inflationary environment. So while that may be helpful for margins, that does not change the fact that there's wage inflation. Much like you putting lower quality food in your basket may be good for your budget, does not change the fact that there's food inflation, if you get that point. So even with everything we saw in this jobs report, 100% of those jobs were part-time. Full-time jobs lost. The number of individuals in the U.S. who had full-time jobs were down 1,000. All the jobs were part-time. High school, 523,000 added from high school in the 25 plus category. From the 20 to 24 category, 74,000. So they're doing what they can, using part-time, using less experienced people, less educated people, younger people, all the things to lower the amount that they have to pay. That does not change the fact that there's wage inflation. Now, even with doing all of that, wages were still up 0.27% month over month, or 3.35% annualized. So even with replacing everybody, or not replacing everybody, even with this month where the demographics of the employment shifted way down to those who were probably earning less than the average hourly earnings, you still had average hourly earnings increase by 3.35% annually. So the wage inflation is still there. Just because companies are trying to adapt doesn't make it go away. So the market was responding to it because they interpreted it as lower wage inflation. And I put a posting up on LinkedIn, if you were watching Bloomberg Monday morning, all the commentators and the guests that were on talking about the jobs report kept referring to, and as we saw with average hourly earnings, wage inflation is decreasing. It's lower than it came in, lower than expected. Average hourly earnings is not a measure of wage inflation. The only time that you could look at average hourly earnings and say, aha, wages are going down, is if every job added was full-time, everybody hired was 40 and up, and everybody hired had a BA and higher. And if you have all of that experience and all of that education and all of that full-time burden being hired and average hourly earnings only increased 0.27 month over month, then you would say, we're hiring the most expensive people and all we could get is 0.27? Excellent. But in this jobs report, we were hiring a whole bunch of the cheapest people we could find, and the lowest we could get it was 3.35% annualized. So it's still there. The way you describe your options trade on U.S. REITs makes the trade seem like a no-lose situation. For me, it is. Yeah, it is a no-lose situation. I can show you how to do that. 13% dividend yield on agency. Yeah, 13% dividend yield on price. But if we look at what the dividend yield is based on what the net margin would be, they hit a record on their net margin income. It's significantly lower, so the affordability of the dividend is not in question. Income from selling options, yep, fairly stable price at tangible net book value. Well, we don't know yet. Their last reported tangible net book value was around $9, but with spreads coming in and mortgage rates dropping, we know that their book value is going to be higher. Almost seems too good to be true, which of course doesn't happen in the market. What would you say are the biggest risk downside to the strategy? What sort of arguments would you make as to why relatively inexperienced retail investors shouldn't engage in the strategy? Okay, so I'm using agency. There are two really big mortgage REITs that deal with agency mortgage-backed securities. Agency mortgage-backed securities are guaranteed by the government, so there really is no credit risk in these particular securities. But they're trading with wider spreads than credit-risky bonds. It just doesn't make any sense. If you're going to do something like this, there are lots of mortgage REITs out there. But what you want is best in class. You want to go for the single best company in that space. It's either going to be Annaly or agency. Always pick best in class. And when you pick best in class and it's trading at a value multiple, which is for agency, was trading well below book value and was massively oversold, if you sell puts on something like that, you win two ways. If the stock rebounds, you get to keep all the money on the puts. If it's put to you, you're buying a winner. You're buying best in class. No matter what happens, I'm comfortable either way. I only sell puts on things that I am comfortable accepting. If I'm not comfortable accepting the underlying, I don't sell puts just to make income. I find a stock that I don't mind owning at a certain price and I sell puts on it because I don't mind that. So when we look at home builders, best in class, D.R. Horton and Lennar. Those are best in class. In every sector you go into, find the best in class companies, the one or two that are the best in their sector, the leaders in their sector. They're the safe ones to sell puts on at certain prices, because if they do fall in price, you don't mind owning best in class. So that does become a no-lose situation. What is my downside? I'm going to have agency, which is got a huge dividend. It, in its last earnings report, posted a record for their income, for when we look at their spread income, which is what we should be looking at, not their net income, their spread income. Their net income is going to reflect changes in book value. Well, those are just changes in book value. By all measures, agency is extremely undervalued and at the lower end of their leverage range. So it was a no-lose situation to do that. You can't just pick a stock at random and say, well, I'm going to do this with this stock. It must be best in class, and it must be fairly valued or at a value level. When I say fairly valued, you don't want to overpay for something. You want to pay a fair value, but you'd like to get it at such a cheap multiple you can't believe it's trading there. And there are deals that happen all the time, but best in class. Let's say you own equity that currently trades at 100 and you want to sell a covered call at 105 for income. Okay, you're selling income, so you're measuring your income by a dollar amount. That is the wrong way to measure an income strategy. An income strategy should be measured by the delta that you take. So rather than say, well, I'm going to, it's at 100, I'm going to sell the 105 calls. Well, what delta are you selling? Because if you're selling for income, you want to reduce the probability that it's being called away. So if this is your stock here and this is your distribution, what you want to do is you want to find a call, a strike price up here that minimizes the probability of this thing being called away. Typically, you'd pick a delta of about 0.2 if you're looking for income. So it's not a question of I want to sell the 105s. It's at 100. What option has a delta of about 0.2? And if you do that, and if you're doing it for income, then you will minimize the probability of it being called away. Because if it's called away, well, then it's no longer income anymore. You don't have an income factory, right? So I would sell it at a delta of 0.2. What you can do if you feel like adding on a pullback is you'd sell a call at a delta of 0.2 and you'd sell a put at a delta of 0.2 and you'd double your premium on both sides. So if it's put to you, you get it at a lower price. If it's called, you do get a higher price, and if it's not, if it stays within that range, you get double the income. For that, you need a low volatility stock, but the premiums sort of disappear on low volatility stocks, or you need a low volatility market. But if you are selling for income, because that's what you're saying here, if you're selling for income, pick a delta that has a low probability of being called. Okay, this is a long one here. Second question, I looked at your applied series, but I could not find a specific video on leaps, particularly on the call side. No, I didn't make a video particularly on leaps because a leap is nothing more than a call option. It's just a long-dated call option. So it's not like a covered call or a strangle. It's not a strategy. It's just a type of option. It's just and if you're following along with the different call option strategies, you can turn any of those into leaps if you so choose. Leaps are used, there's one video where it's called the covered call, and I show how you can buy a call on a leap basis and then sell monthly calls against it as a form of a covered call. But it's in there. It's just that a leap is not a strategy. A leap is just a different type of, it's just another type of option. In terms of my personal view, I'm on the recession camp. Quick look at the various yield inversion curves. The LEI that is plummeting very rapidly, M2, has also dropped. Latest FOMC minutes, economic data that seems to be degrading. It's enough to convince me that there is higher likelihood of a recession than not. While I do not think call leaps make sense just yet, I do believe in 1 or 2 quarters it could potentially be a good time, especially if markets have hit new lows. And close to October lows. Plus, if we see the specter of the economy recovering and volatility is not too high, make leaps not too expensive. That's a lot to ask for. You're asking for just the perfect scenario all at one time. My question regarding leaps are, do you ever personally use them? If so, what role do they have in your portfolio? Yeah, if you've been following the TLT trade, I'm using January 24 110 calls. Some of the calls are 110 calls, so it's in there. I am using leaps. Are leaps typically better to target at an index level or at an individual security level? It doesn't really matter. It depends on what you're trying to get done. Keep in mind when you're going into leaps, the difference between the bid and the ask really widens, so you're going to have to try to get something in the middle. You can get in, but if you got to get out and you need to get out quick, it's going to take some time. So whatever you're getting your leaps at, you either want to make sure that you have no real desire to get out of it, or make sure it's as liquid as it possibly can be, which means you'd want to be at the level of either the sector or the ETF, I guess. I know it's better to short options with 30 to 45 days, but in the case of leaps, would it make sense to short leaps puts in order to finance the purchase of leap calls, especially the volatility skew is on our favor? Yeah, but the interest rate is not in your favor right now. So the with leaps, you have to keep in mind with any option is you are not selling options based on today's price. You're selling options based on the forward price. So let's draw out our stock chart, and let's say our stock is right here. That's today. Here is 30 days, 60 days, 90 days, all the way out to a year. Well, you can take the spot price and you can multiply it by whatever the interest rate is times the factor, and T is in years, so 3 months is 0.25. And that will be the forward price. And the higher the interest rate, you know, if you have a low interest rate, there's the forward curve. The higher the interest rate, the higher the forward curve, right? So if you're going out a year, if this is $100, this might be $108, so that the 50 deltas, the call and the put, are centered around 108, not 100, which means you may want to buy the 110 calls, but you'd have to sell the 106 puts. Well, the 106 puts are higher than where the current price is right now. So you got to be careful about how much time value you have in here and how much dividend earnings power is still left in that thing over that period of time. So because you're selling on this forward curve, the higher the interest rate, the less desirable that becomes, even if you look at your skew and you have volatility skew that looks like this, and you have higher implied volatility on puts than calls, it will be centered around a much higher price than where you are today. So you can buy your calls on low. When implied volatility is low, you can buy your calls, and the way I would do it is I'd simply just buy the calls at that point in time. And that's step one. If the stock continues to rally after you bought your calls, well, you're making money. Very good. Go above it and sell some other calls, so that if the stock pulls back, take your profit on the calls above. You still have your long position. When it pulls back and implied volatility increases, sell some puts that are 30 to 45 days out. You know, and the next time it rallies up, you close these puts and you start thinking about the calls up here. Now, these calls can be leaps. The ones you're buying here can be leaps, but you'd want to sell short-dated calls. And you got a year. You got a year to get cash neutral. Wait for the perfect pitch. You don't have to chase it. But just bear in mind that when you are buying leaps, if you're going to sell puts on leaps with an interest rate, and what is the 1 year interest rate? 4.3, 4.4%. So the price of that option is going to be at least the mid price. The 0.5 deltas are going to be centered around a price that's 4.3 to 4.4% higher. If you have less than 100 shares of any particular name, or shares which offset multiples of 100 and are wishing to reduce your position sizing, are you willing to buy the remaining shares such that you can sell puts to capture the premium? Well, if I'm reducing my position sizing, I'm not selling puts, I must be selling calls. Puts would add to my position, taking on the price risk, understanding the short-term gain or loss component. Well, if I have multiples of 100, I don't have to do that, so I think we can eliminate that. I think your question, if I have less than 100 shares, would I be willing to top off to 100 just to sell a call against it? It depends. Am I capacity constrained? If I am capacity constrained, then I have to look at the opportunity cost of having money tied up just to make the small little amount that I would make on the premium. What could I potentially miss in the interim? I mean, if you're holding on to 100 shares of a $50 stock, and you sold a $52.50 call against it, and you're hoping that you can earn that premium and still own the underlying. Meanwhile, the market is just rallying because inflation is low and it's moving up every single day. Why would you want to sit in a low return strategy when something else is moving like that? If I'm not capacity constrained, well then, yeah, sure. If I wasn't going to use the money for anything else anyways, why not? If I felt like it, sure. If the premium was worth it, why not? But if I'm capacity constrained, and I would imagine if you have less than 100 shares of something and you're debating whether or not to add the rest, you probably have a smaller account. You're probably capacity constrained. I would say, given the high interest rates and the potential for other things moving while you're sitting in one position waiting for a covered call to pay off. If it doesn't have good premium, I would say, probably not an exciting trade. I don't think I have a very good answer for you here. My opinion on HOUS, the ETF, I did consider it and I rejected it. I think it was because of the options, but I did reject it. Thoughts on Ally? I have no thoughts on Ally. I'm really not into the used market at all. Also, I'm not really into a whole bunch of retail type businesses. So things like Abercrombie and Fitch and things like that. Things, some of the luxury brands, Coach and all that stuff. I'm not into that kind of stuff at all. The consumer is fickle, and I really don't feel like trying to figure out the consumer. The best times and places for that are in a confirmed expansion when economic growth is, robust and expected to continue. Interest rates are low, and everybody can charge it to their credit card easily without having to pay a lot of interest on that stuff. I want an environment like that where consumers just feel like spending. And I don't know that we have that. So, and I don't think that I would distinguish between one brand or another, because I wouldn't know the difference between the brands. I'd probably just buy some sector, some ETF that tracked it. But I'm not into that part of the market, so I really don't know much about that. Let's say you were long a diagonal call spread, selling front month calls against a long call leap. Why would you do that? I don't understand why you would do this. Why would you sell the call if you're long calls? If you're long calls, you must have had some thesis or some story about why you wanted to be long the call. Why would you then negate that story by selling front month calls against it? Unless you're trying to time the market, which doesn't seem like a good strategy. If you have a story and you bought a long call, you have two choices which are smart and consistent with your theme. Is you sell puts behind the price, so you sell puts below where the price happens to be on a short-term basis, or on rallies up on your leap call, you sell a call above it, so that if it continues to rally, you're okay. And if it does pull back, well, then you can make money over here. But if it continues on, well, you're not going to be hurt because this is a leap as well. You've just limited yourself to the spread at this point in time. But if I'm long a leap call at 100 for a stock that's at 60, I don't know why I would sell the front month at 70. It seems to be negating the very story that I have over here. It's inconsistent with what you're thinking. So I don't know why you would want to do that. Let's also imagine we are nearing the expiration date for the short call and it's in the money. That's your risk. Right? That is your risk. Your risk is that your story is playing out exactly like you thought it was, but then you bet against it. That's the risk. You bet against the very story that you believed in. You don't want assignment because you don't want to own short the stock because it is inconsistent with your story, right? So if this is, you'll have your answer here. If you don't want assignment because you don't want to short the stock, you should not have sold that front month call to begin with. I'd like to know the most optimal way to handle this situation. Most optimal ways, don't do it. But having been in trouble, as you would be now, and you don't want assignment, rolling would probably be your optimal bet, unless you need, unless you can't see market weakness. In other words, you have to hope for market weakness, but the conditions in the market do not speak to market weakness. So right now, the conditions in the market speak to a high probability of market weakness, that it is not inconceivable to see market weakness. However, if the stock is just going up and up and up and up and up, rolling that thing again and again and again will just create bigger and bigger losses. So I would say that if your story is a bull story on the underlying and you see it going up and you bought the call, your best bet is to sell puts below the price to get cash neutral, or on rallies, sell calls above the call that you have. Not below, but above the call that you have for the same time, and you can avoid that situation altogether. Okay, page 3, paragraph 1, sentence 5, consistent with the decline in volatility. Model-based measures. This is the key right here. They're model-based. Model-based measures suggest that a drop in term premium accounted for much of the decline in treasury yields over the period. What does term premium mean? Well, you have different time periods, right? 1 month, 3 months, 6 month, 1 year, 2 year, all the way out to 10 years. If you're going to lend money for 1 year, you'll get a certain return. If you're going to lend it for 10, you kind of want more return than just the 1 year. The difference between what you would want for the 10 year and the 1 year is considered the term premium. It's the term premium. So that's all they were saying, is that the drop in treasury yields was a result of a drop in term premium. That's model based. It's just model based. That's all it is. Can you please go through if and when you decide to roll a short put that is a loss? You sold a put at 100 and the stock is at 90 at expiration. Want to understand your position, think for how you would manage that position. I have a choice to make, and it depends on the pickup that I can get. So let's say I sold a put at 100. The underlying is now at 90, and expiration is today. So I have a choice. I can either close it and take my loss. Let's say that I got $3 for selling the put. That means I am down $7. I can take a $7 loss or a $700 loss per contract. Or I can look at next month's $100 put, and I can look at the pickup that I would get. So I'd look at it in terms of, well, how much is the put? When it's this far out, it depends on the volatility, but let's say that the $100 put is selling for $10.40. Since this is already $10, I'm only getting a pickup of 40 cents. That doesn't really turn me on to hold that position for a pickup of 40 cents. Doesn't really excite me. But if I could sell this option for $11 or higher, I'm getting a pickup of $1, which means instead of $3 that I paid for this, I've now paid $4 for this, still with a strike of 100, but now my break even drops to 96 because of the pickup. It depends on the pickup. Now, if I have it assigned to me, then I'll own stocks at 100, which have an average cost of $100. I will compare that with, if the pickup is 40 cents over here, how much is the call over here? Maybe the call is 80 cents. Well, the call is double the pickup I would get on the put, so have it assigned and sell the call for 80 cents has got a better chance. Even selling the 99s might be $1 or $2 or $1.10, let's say. It just has to be more than $1. That means I'm already at break even by doing that. I would probably do that. But yeah, it really depends on the pickup that I can get. Sometimes when you're deep in the money like that and you're rolling puts, the pickup is nothing. Sometimes it's as little as 20 cents for a pickup, to hold it for a whole other month for a pickup of 20 cents. Just doesn't make a lot of sense to me. A negative number on the temporary help services would indicate that fewer and fewer part-time, you can't say part-time, fewer and fewer temp workers are being hired month over month. Because you can hire a temp full-time. You can call a temp agency and say, I need somebody for 4 months, and they would be full-time. Part-time means you've hired them yourselves. You can hire from a temp agency. If so, wouldn't that contradict the idea that businesses are bringing on more temporary workers to reduce the cost of full-time workers? Usually you don't bring on temporary workers to reduce the cost of full-time workers, because temporary workers will cost you more. Because you have to pay the temp agency more than what the temp agency pays the employee. So you'll always pay more, but you pay more for a particular reason. You don't have to worry about employment laws too much in terms of hiring and firing when it comes to a temp worker. So you can have a temp worker on for 6 months, and let's say after 3 months they're not working out. You can call the temp agency and say, I don't want them tomorrow. You can get rid of them that quickly. And it's over. You have no obligation in terms of severance. You have one bill from the temp agency, and that's what you pay. You have no employer health costs associated with that, no employer tax associated with that, and you're not really responsible for them. If they're not working out, you just say, I don't want this person here tomorrow. That's it. You don't have to sit them down and fire them and potentially have to pay any kind of severance if they were there for too long. You'd usually use temp workers if you can't find the workers yourself and you need somebody for a period of time. Or you have an increase in demand, but you don't think that demand is going to be permanent, so you don't want to bring on any full-time employees at this point in time, so you'd usually hire a temps to get that done. When things are slowing down, if you did have temps, usually you get rid of your temp employees before you get rid of your own permanent employees. And then with your permanent employees, you typically cancel overtime first and bring them down to regular hours before you get rid of them. And then you'd maybe shorten the work week before you actually lay them off, because laying them off is usually a last resort. Most business owners really don't want to lay anybody off. They really don't. Even though it may seem like, some companies release employees far too easily, usually it's a last resort. Usually they don't want to. If you look on the BLS site, temporary help services is part of employment services. So when we look here, professional and business services, temporary help services, these are the businesses, these are the temp agencies, not companies saying, I let go of a temp worker. This is a temp agency, and you can have a temp agency, let's say you're Aldo Staffing. I'll just make up a name, Aldo Staffing. And you have 5,000 people that are ready and willing to work, but no one's working. You have zero employment. These people aren't employed. Only when they're on a job are they employed. So you may have 2,500 of them out on jobs and 2,500 of them waiting to be called. Well, then you have 2,500. So staffing agencies are saying, we are down 22,000. Next month, we're down another 30,000. Next month, we're down another 35,000. That means companies are not calling the staffing agencies for more people. They're calling the staff agency saying, we don't need this temp to show up. A temp is more expensive than a part-time person. A temp can sometimes be more expensive than a full-time person. Because keep in mind, if you're hiring a temp for something, the temp agency, Aldo Staffing, pays the person, right? Well, usually whatever you pay the person per hour, let's say you're paying $20 per hour, it's usually a 1.27, multiplied by 1.27 for their full cost. And then there'll be about a 40% markup from there for what you would pay. So you're paying significantly more. 1.22, 1.23, sometimes 1.27. It depends on the type of job that it is. And what they're trying to get done. Because keep in mind, the staffing agency here is the employer. And this, Aldo Staffing, comes with all of the legal responsibilities that an employer comes with. The place where the person goes to work is not their place of employment. Aldo Staffing is their place of employment and comes with all of the baggage that labor laws come with. And that's usually why you don't mind paying the premium, because if you want somebody for 3 months, you don't want all of the baggage that comes with that. That typically means workers' comp is the responsibility of Aldo Staffing. So, depending on where they're working, it could be expensive. But because they're losing employment, that means they may still have these 5,000 people willing to work, but instead of 2,500 working, now only 1,000 are working. Now only 500 are working. Now the phones aren't even ringing. So that's what this trend is pointing to. Okay, somebody had asked me a question about what evidence could they provide to somebody to show them that TQQQ would in the long run be a loser, because these things really do walk themselves down to zero. When you hold this for longer than a day, you're hoping that a stock will move in the same direction day after day after day. That's where they can really pay off. That's a big bet to make. Typically, these are used for one-day risk management only. So here's a one-day performance. The triple Qs are up 0.85. Multiply that by 3. We should see the triple Qs up 2.55. It's up 2.67. Good enough. 3 months. Qs are up 1.63. TQQ should be up 4.83. It's actually down 4.69. Let's go 6 months. QQQ is down 7.24. Multiply that by 3. That's 21.72, negative 21.72. TQQQ is negative 33.36. Let's go 3 years. QQQ is up 27.01%. So a triple that is 81%, but TQQQ is down 21.19%. Anything more than a day. Mathematically, you can take any return series and apply it to TQQQ. Any return series that has multiple sign changes, where you're up a couple days, you're down a couple days, you're up, you're down, you're up, you're down, you're up, down, down, down. And it will walk itself further and further away on the lower side from what it is that you're tracking. Mathematically, it will just do that because it's not compounded, it's tripled. So it's just 3 times the daily return. It's not compounded. If you really want leverage, use futures contracts. Futures contracts have huge leverage, and they will track the underlying point for point with huge leverage. If you think 3 times leverage is something, it can track it with a lot more than 3 times leverage. But these will eventually, over time, if you hold them for long periods of time, walk themselves to zero. The only time that they end up doing something like this here is when you have a sustained move in one direction in the underlying. So if it's going to move in one direction and it's going to have a bunch of days where it's just up, it's up by 1.5%, 2%, and whenever it's down, it's only down by like 0.5, 0.6%. So that when it's up, it's up. When it's down, it's not that bad. Then it'll travel in one direction like this. But notice if you get a whole bunch of down days in a row, look at the small little down that you had in here. Look at the massive crash that you have in this triple thing, because it's 3 times every single day. It's not triple compounded, it's 3 times every day. Bad decision to hold this for any long period of time. Your comment on greed versus fear. If you desire to take an initial position, taking a partial position, however, there is positive momentum in the equity, do you still sell in the money puts? Yeah, I can do that. I've sold in the money puts before. If I think that the underlying is going to rise and I just want to get a better price, I'll sell in the money puts, which in such a way that would guarantee me that I would be put. It's just I'm going to get to buy them at less than the market. So let's say the stock is at $45 and I can look 1 month out and I can see the 5250s, because 750 is a pretty big rise 1 month. I can see the 5250s for $8.10, let's say. Well, there's 750 that I got to pay, that it's in the money, which means I'm getting an extra 60 cents out of that, which means when everyone else is paying $45, I'm paying $44.40 for it. And if it rises to 52.50 and beyond during that period of time, well, I did pretty good overall. So yeah, I will sell in the money puts if I do believe there's upward momentum and I just want to get a better price than anybody else. Let's say on the money puts, which may have unfavorable IV or premium and risk you getting unassigned. Yes, you've collected the premium, or just buy the equity outright, taking the price risk and adjust position sizing from there. How should one look at the regret aversion bias when you have a high conviction in play? Yeah, there are some things when I have a fairly high conviction, I won't bother stepping in fifths or quarters or thirds. I may take half a position or 60% position, or even more. I may just go all the way out and get aggressive and sell a whole bunch of puts against it, saying, well, I'll take what I get. And it depends. If the options aren't liquid, then you go into the underlying. Usually I don't like underlyings that don't have liquid options, because then I'm limited in my risk management unless I can find an ETF proxy that proxies the group. So I have a bunch of REITs, which they don't really have very liquid options on these REITs, but they have nice income, and I don't want to keep buying and selling them. I just want to own them. So I'll use a REIT ETF, the IYR, and I will sell calls on that index to proxy selling calls on all the individual underlyings by just saying, well, look, I'm just going to use an index to get it done. I don't care where I get the short delta from on the REIT side, from each individual position or from the index. So I don't mind doing that. But for, if I do have high conviction on something, it depends. It really depends on how I'm feeling. I may buy 5,000 shares and sell 5,000 puts, at zero point 0.7 delta or 0.65 delta. I may do something like that. I may buy 5,000 and sell 5,000 at the money puts. So if they don't get put to me and they move up, well, I get to keep all of the premium on these 50 puts, which means my average price was actually lower on that. It really just depends on the liquidity of the options, what I think is going to happen, what I'm trying to get done, how much extra premium can I get by selling in the money calls, or selling in the money puts. Sometimes the premium that you get just isn't worth it. So if it were $45 and I went to the 5250s and they were $7.65, well, 15 cents. I mean, I'm not gonna do all of that for 15 cents. It's not worth it. For 15 cents, I'll just buy it at 45. Would there be a reason that retail investors need to keep an eye on repos? No, not really. In the video of 3849 about implied volatility, it's after the fact that I should bet more when implied volatility is rising. I don't know what you mean by bet more when implied volatility is rising. I'm not sure what it is you're betting on when you say bet more. So how do I know if I should get into a trade before volatility is rising? Don't. If you think that volatility is rising, usually because of the correlation between the VIX and the SPX, if volatility is rising, the S&P and stocks are dropping. So I don't know that you want to get into a trade before that's happening, unless you're talking about buying a put before volatility rises. So I don't know how to answer this question because I'm not sure what you mean by making a bet or betting more. I don't know what it is that you're betting. 4046 at the Fed funds futures rate in June 23 is predicting to the range of 5 to 5.25. Why the mortgage rate would be printing a 5? Well, this is the 5 to 5.25 is the Fed funds rate. That is the overnight rate. We have a yield curve that is inverted, so the 10-year yield is much lower than where the Fed funds rate is right now. If you have the spread between the 10-year and the mortgage rate compress, you can actually drop on the mortgage rate. Should be more than 7. No, because it's pegged to the 10-year. Is there some useful information to extract from comparing the size of the retirement group to the next generation? Okay, I see what you're saying. So there's the retiring group, and then there's a group right behind it, which is bigger than this group here. So think about capitalism, and I hate to do this, but think about it as a pyramid, right? A better word, I guess, would be a hierarchy, and there's the CEO at the top. There are fewer positions at the top than at the bottom. I think we all know that. Not that I'm intending that it's a pyramid scheme, but if you look at any org chart, it always is shaped like this, because the further down you go, the more the wider each layer is. So when I think it's safe to say that the retiring cadre is usually at the top of the hierarchy. So when they leave, everybody starts bumping up. Whenever somebody leaves, there's a promotion, and then that promotion, and that promotion, and you always have incoming people at the bottom, because you always have people leaving at the top and people filtering up. So you always have people coming in, and sometimes they don't stay because they aren't worth it. So it's not as if those coming in are earning less than those that are leaving. It's just that those that are leaving are making way for those behind them to move up in the organization. And if everybody moves up, you have empty spots at the bottom, and that's where people come in. It's just the group coming in now is smaller than the group that's leaving, so the participation rate drops. Let's see. I am making the assumption that those entering are not entering with the same jobs as those retiring. No, doesn't matter. This in mind, I would expect to see decreasing higher end jobs. No, but any statements about the jobs of those entering the market, I would want to compare with the generation just ahead of them. I see what you're trying to say is that, okay, well, these people are retiring and other people are entering. The higher paying jobs are leaving and the ones entering don't have the higher paying jobs, but that's really not how it works. If a VP retires, the assistant VP moves up, the one below them moves up to AVP, everybody moves up, and then somebody starts in the mailroom. So it's not as if incomes are affected because everybody just moves up to the next level of income. What is affected is the size of the labor force, because the retiring group every day that is leaving is less than the rookie group that is entering at the bottom. Okay, I remember you mentioning you may plan to include this in the AS, but I was wondering if you have any tips on how to create an IPS. And here you're asking an IPS for a retail investor, meaning that you're going to create an IPS to manage your own account. And I assume that you're going to be more than just a passive investor. Because if you just are going to be passive, you can find lots of personal IPS statements online that you could just download. Passive just means you're going to have a strategic asset allocation. You're going to allocate to a number of ETFs, and then you're just going to go away. But if you're going to be active, then you need a business plan. And your business plan is your investment thesis, or what it is that you're trying to take advantage of in the market, what it is that you're trying to do over time. And you would have certain investment procedures, which are rules. Maximum position size, minimum holding periods, whether or not you are going to be tax aware or tax agnostic, things like that. But I remember years ago I wrote up a long sort of manual about this, and I don't know whatever happened to it. I had it somewhere. I don't think I ever finished it. If I could find it, I could just post that. But yeah, I can get something like that done. But if I do something like this, here's the target market for it. It is somebody who's decided that this is going to be a profession for them, that they're going to be an independent investor. I'm going to use the word professional retail investor, which is sort of an oxymoron, because a professional is usually somebody who manages money for other people. But if you're managing your own money and you're doing it because it is your income, it's the job that you want, it's going to be a source of income, I think that's a professional retail investor. For that, that's the target market. Well, for that, you're going to need rules, because if you have no rules, you're going to get into trouble again and again and again. Rules are meant to keep you out of trouble, and rules are meant to make sure that you're running this like a business, you're treating it like a business, and that you need a certain amount of income per year, so you have to get that. And you don't get that by swinging for the fences all the time. Sometimes you got to do some really boring stuff and hold boring positions, but those boring positions end up being good income earners. I can do something like that. I was going to do the factor investing video was done in the top-down sector. I was going to do contraction video next, because I've already started working on it. After the contraction video, I was going to do probably Freeport-McMoRan from a bottom-up perspective, but I can stick the IPS in before I do Freeport. How's that sound? So I will do contraction video next. I will do the IPS, and then I'll go on and do Freeport. Did you try to sell more ES futures when it rallied to 4,000? Yes, I did, but I had a tax appointment downtown with my accountant at 11, and I had to go to the TD Bank to get something for him, and the TD Bank around the corner was closed. So I had to get in my truck and drive all the way across town to the TD Bank, all the way back, and then I had to drive all the way home, and by the time I got home, it was sitting at around $39.92. I put a sell in for $39.98, and I never got it. Damn it. But, I may get a chance later this week. How big of a position do you normally take initially? It's hard to answer these types of questions of how big a position I take, because I take the position that for me is necessary to reduce my portfolio risk to a level that I want to keep. And I've been very successful over the last couple of months of keeping my volatility in my portfolio ultra low, while still making a good income, so that my portfolio doesn't do this kind of thing. It does this nice and slow every day, nice and slow, because I keep the volatility nice and low. And until we have a lot of this uncertainty gone, I really don't want to increase that. So the size is not important as the end result at the portfolio level that I want to reach. So sometimes it could be just 8 or 9 contracts. Sometimes it's 23. It depends on what I'm trying to get done and what other exposures I want. So let's say that I find a really nice long position. I think I want to take on this long position. But that will increase my volatility. Well, depending on what I expect in the market, I may use some of these call options on the index or futures on the index to lower that volatility. As long as I expect that there's going to be downside to the market, I don't mind putting those on. I don't always use them. I'm comfortable with 1 ES contract, so I sold 2 MES at 39, 2 at 39.70, 2 at 4,000, but it dropped back down before I can take the full position. Do you follow your intuition? Do you have a set of rules for this too, like the option rolling mentioned on Tesla? For this, it's your exposure, right? So as the market is moving up, my long positions are moving up. And some of the puts that I have are decreasing, like especially the puts that I sold are decreasing in delta. So while they're decreasing in delta, my portfolio delta starts to increase. And depending on what's going on, I may say, well, I was nicely hedged. Now I'm slightly, I'm slightly over where I want to be in terms of my dollar delta beta. So, I look around for something interesting that I can add. And if there isn't, well then, if I'm still of the belief that we're going to see some downside, then yeah, I'll add more on. But I can't give you a rule, because the market is just too complex for there to be just a simple rule that you would follow. 3 comments, hope you could share your thoughts. Regarding the labor shortage, would you think that illegal immigrants, take out the word illegal, because, we shouldn't do that. Do you think immigrants should solve the problem? Yeah, I think they could. We all heard about southern border issue, and as an investor, should we support them or against it? Well, I think, let me put the immigration issue into a context that's easy to understand, so that we can see that, it's not a matter of being heartless, it's a matter of being practical. So let's say you're having a party. Here's your house, and you have 3 bathrooms in your house. You know how much sitting room that you have. You've ordered enough alcohol and enough food, and you're going to have 35 people over. And some people start showing up uninvited, and there are 20 people outside that want to get in. And so you're standing at the door and you're saying, look, here's the deal. I simply don't have the bathroom space for all of these people. If I let you in, there'll be lineups for these bathrooms all the time. I didn't buy enough alcohol and enough food, so if I let you in, these 35 people are going to not have as good a time as they could, because I've optimized this party for 35 people. So I didn't invite you. You can't come in because I simply don't have the resources. And if I did let you in and had 55 people, it's going to be too crowded. People aren't going to have a good time. They're going to have to wait for the bathrooms. I'm going to run out of alcohol. I don't have enough food, and it's going to be a mess. That's the problem with illegal immigrants showing up at your border, is you have to say to them, look, we'd love to let you in. We have a process for letting you in. We have enough resources to handle, let's say, 1 million legal immigrants a year. but not 5 million a year. We just don't have the resources to handle all of that. And it would just cause a whole bunch of problems for everybody involved. So you have to think about the welfare of everybody else. And that's why there are limits. Every country has limits to their immigration because there's simply an infrastructure in the country that has to handle the amount of people coming in. So yeah, I think that immigration could solve the problem, but you can't just say, well, 5 million people, come on in, we need 5 million workers. There is a process for getting that done. You can solve a lot of this southern border issue and this labor shortage issue by looking at foreign direct investment into Mexico, which is what the Canada, US, and Mexico are doing this week. They're meeting in Mexico, and Mexico's making the case that, hey, you should be putting your money into our country. We have the labor force. We're a friendly country. We are part of a trade agreement, are we not? Because the Mexican president said, I'm looking out on the oceans and I'm seeing Asian ships pulling up at your ports all the time. What's up with that? Or as they say on Saturday Night Live, what's up with that? Regarding the ES trade, how would you compare that with shorting SPY? Well, when you short SPY calls, that's all you can make is what the call is, and it is a convex play. So if you short the call, you have a trade that looks like this. You can only make a certain amount of money, but you can continue to lose. Whereas if you shorted ES, you have a vertical trade. You don't need the convexity. Selling forward month calls at 0.3. That's a lower risk strategy than the ES because the ES is a linear payoff, not a non-linear payoff. I'd like to hear from you about CAD versus US. CAD will go as US goes. Playing CAD right now is playing US. Playing the Mexican peso is playing something. There is some strength in Mexico. But CAD just is... if the US is weak, Canadian's strong. If the US is strong, Canadian is weak. So it's hard to play the Canadian without saying, I'm really just playing the inverse of the US dollar if you're playing the Canadian, because there doesn't seem to be any particular movement in that pair that you can say, well, that's a Canadian dollar move. It all seems to be, well, the Canadian's moving because the US is moving. So I don't really have an opinion on it. It is basically nothing more than a US dollar trade. There is nothing special about the Canadian at this point. Thoughts on ChatGPT and how AI can be used to analyze markets? What kind of dynamic do you see playing out if everyone is using AI to invest? Thank you for everything. So somebody had sent me this. So I signed up and I tried it out. And I said, what is X? And I gave it a financial term. It was a rather esoteric financial term. And it gave me a description of what is X that I recognized immediately. So you cut and paste and you get right to the website and it's word for word. So all it was is just a search engine. If I had asked Google what is X, the very first link would have given me that. So I think, okay, well, this is just Bing by another name, Chat GPT. So I then said, give me an example of X. So it started typing out an example of X, and then the cursor stopped and just was blinking. So I took the text, I put it in, and I found it, and it was a website where that's as far as it goes, and you have to pay a fee to get in. And that's as far as it could cut and paste. So then I asked it a tougher question of which I could not find an answer. I actually had to, for the term that I was looking for, I actually had to find an expert in this field and say, I'm having a little trouble getting my head around this concept under these conditions. So I asked it for that, and it answered error. So I asked it in a different way, and it said error. So I asked it a scenario, and it said error. It seems to me like a very, very advanced search engine. But as far as solving a complex adaptive problem that really has no specific solution, it doesn't seem very good at that. Well, that's the market. The market is a complex adaptive problem that has no real solution. It has a bunch of equilibrium points based on where it moves to. Wherever it moves to, it adapts very quickly to that level, and that's the solution for that point in time till it moves to another level and adapts there. It's extremely nonlinear. ChatGPT is never going to be able to build intuition and experience. All it can do is build a database of answers that it has probabilities of saying this seems to be what everybody had before. And this seems to satisfy everybody's answer from what they had before. So I don't know whether is it a contextual web search tool? Is it Bing by another name? It felt to me like it was Bing by another name. But when I started asking questions of things I didn't already know the answer to, and things that I know I couldn't find online, neither could it. So since it cannot do that, I know that it can only find what I can find online. So maybe it's a faster search engine. But I don't know what all the excitement is unless I'm missing something really, really obvious. Now, if you went more into the hard sciences, in other words, complicated problems, maybe it can solve complicated problems. So what is the difference between a complex problem and a complicated problem? A complicated problem has a solution. So a very advanced physics equation is extremely complicated, but it's got a solution. You can solve a complicated problem. Many engineering problems are complicated problems. A complex problem has no solution because it is complex. That the solution itself would change the system, thereby making the solution incorrect for the next phase that it would adapt to. That's what a market is. It's a complex adaptive system with multiple equilibrium. There is not one equilibrium. When we talk about equilibrium pricing, it's like, okay, equilibrium pricing for what though? For what time of day? For what type of market? For what type of environment? For what country? For what type of market system? For what type of liquidity? There are multiple equilibriums. There is no solution to the market. There is no solution because it is a complex system. If you're looking for a solution in complexity, you're missing the point about what complexity is. AI is going to have a very difficult time with complexity. I'm highly skeptical that it's going to replace anybody. And what I'm very hopeful for is that a bunch of people feel that it can replace people, thereby relying on it. And if they can, that can be gamed. So I'm hoping that it does do something because it will have these quasi-solutions or these solutions to a problem that has no solution. And their solutions will create the opportunities for me to take advantage of because that's what complexity is about. Complexity is if you push on something, something else moves. That you can never, ever get a solution to the system. So, no. I have no belief that is ever going to obsolete me. Now, here's what I was doing when I was doing this. What is X? Give me an example of X. And giving some conditions under which I wanted you to generate something for X. And I thought, perhaps GPT might be a fantastic way to generate exam questions. Perhaps it just might be an excellent way to generate them. No, because it gives you an answer that's already from a website. And the worst crime, I think, is it doesn't even cite the website that it fully copies the information from. So it seems like it's a giant plagiarism machine that really just is a more, more restrictive search tool because it only gives you one possible answer. At least Google gives you the top 4 or 5 so you can look at a whole bunch of different ones and say, okay, this one says this and this one says that and this one says this, but when I bring all 3 together, I'm getting a good picture of it. This one just plagiarizes blatantly from the website, doesn't cite the source, so even if it did give me an example and I thought there's a good exam question, I couldn't use it because I don't know who owns the copyright on that. I don't know where it cut and pasted the answer from. I wanted to know whether or not it had the ability to teach, whether it had the ability to develop multiple choice questions or complex exam questions based on what it knew. So what is X? It gave me an answer. Okay, well, if you know the answer to X, give me an example of X, which could have been the basis of an exam question. And it was just cut and paste. It was just cut and paste and massive disappointment. I say massive disappointment because we've hired question writers before who have done that, cut and paste questions from other sources. And plagiarizer. So I don't know, maybe I'm missing something. Maybe somebody's seeing something more than I'm seeing out there. I don't know, maybe I'm just missing something. But to me, it seems like another blockchain, Bitcoin type thing going on that everybody's all excited about and money's going to rush in and we're going to find out at the end that, you know what? I mean, this isn't that great, is it? I don't know. Maybe I'm missing something. You tell me. But based on the examples that I gave it, it's like all you're doing is plagiarizing and not even doing it well. I even asked it a simple question. A simple question. Who is Mark Meldrum? Error. Where does Mark Meldrum live? Error. What does Mark Meldrum do for a living? Error. You know, for me, it would seem like, well, wait a minute here. If you're this really smart AI thing, couldn't you tell what country I was in? Couldn't you narrow down all the Mark Meldrums you found to say, well, if you're asking who Mark Meldrum is, there's a high probability it's going to be somebody in your country. So why don't it could have followed up with a secondary question. How do you know Mark Meldrum? Oh, I work with him. Well, my God, couldn't that algorithm narrow it down a lot more? Couldn't it be adaptive? Couldn't it think? And it couldn't. It couldn't do any of that stuff. Like seriously, if it were me, I would think, well, if somebody's asking this question and there are multiple answers, I'm going to look at the common characteristics of all of these things, and I'm going to look at the separating characteristics of all of these things, and I'm going to say, well, it must be something about the separating characteristics that allow me to identify it. I would ask a follow-up question based on the separating characteristics. No. Error. So, unimpressed on this side altogether. A question related to the previous video on arriving at a hurdle rate when it was the sum of the risk-free rate and risk premium. Okay, keep in mind I'm using the word risk premium and you're saying risk premium too. That is not yield, that's a risk premium. I'll explain what that is here. However, money can't be invested in both at the same time to get these returns. If I have $100, it can either go into a risk-free U.S. bond or a BBB rated bond, but not both of them. In the BBB rated bond, you have the risk-free rate and you have a credit spread. The credit spread is the risk premium. A premium is the yield you have in excess of a risk-free rate. It is the premium in excess. So that is why you add it together, because a risk premium is the return minus the risk-free rate. That is a risk premium. So if we want the risk premium for the market, it's the return on the market minus the risk-free rate. It's the premium up and above the risk. Let me finish that line. Up and above the risk-free rate that you get. So maybe you just were confusing risk premium with the whole thing. Okay, do you mind sharing your 2022 year-to-date performance? Almost everyone lost money in 22, but did you outperform the market using the option strategy you taught us? So that is much more difficult to answer than you think. I'll give you answers. I'll give you 4 different answers, and then you can determine which one you like. But let's say that I'm your money manager, and you have come to me at the end of the year, and you're saying, did you beat the market? I'm going to give you 4 answers, and you tell me which answer you think makes more sense for you. Answer number 1, I don't know. I don't know yet. A significant part of my cash flow return are dividends. and many of them come from REITs. Well, it is not uncommon at the end of the year for REITs, when they give you your dividend slips, for a significant part of it to be what's called return of capital. I won't know what that is until end of March, beginning of April. So I really won't know what my return actually is until I know what my return of capital component happens to be. So when your combined dividend yield on REITs is 6, 7, 8%, well, it could make a big difference depending on what the return of capital is. So if you want to know what my return was, you're going to have to wait until I get my slips from the REITs that tell me this much was return of capital, this much was your unqualified dividend. At this point, I just don't know what it is. The other answer that I could give you is, rather than looking at my performance in terms of percent, wouldn't you want to know what my Sharpe ratio is? Because if I beat the market, I should be more beat it on a risk-adjusted basis. Let me give you an example of how you can beat the market on a percentage basis but lose. Let's say you get a 10% return, but you got that with 30% volatility on your portfolio. Let's say the market did 5% and it only had 10% volatility. Well, I could have just used leverage. I could have levered this up by 2 times to get the 10%, and I would have only had 20% volatility. So if I came to you at the end of the year and said, well, I could have gotten 10% with 20% volatility, but I put you in a lot more risk to get the same return, you would say, well, that kind of sucks, right? So if you look at the 10%, you say, I doubled the market. No, you didn't, really, because you took on a hell of a lot more risk to get that. So this 10% may not be skill, it may be luck. Because with this kind of volatility, it could have easily have gone the other way. So you got to look at 2 things when you're asking, did you beat the market? You got to look at the return and you got to look at the level of risk taken on. And I should not be able to lever up the market to get to the same return with a lower level of risk. If I could have just done it passively and used leverage. So you should be asking me, did your Sharpe ratio outperform the market? My answer is yes, by a country mile. Not just by a little, by a mile. Now, some of you out there right away who are sharp at this, Sharpe ratio if you're sharp, if you're clever, right away you're screaming at me saying, you can't use the Sharpe ratio, you're calling foul. Because the Sharpe ratio is my return on my portfolio minus the risk-free rate. It is what I got in excess of the risk-free rate divided by the standard deviation of the portfolio. This requires a normal distribution of returns, and we know that if we use options in our portfolio, we get non-normal distributions with skew and kurtosis to the point where you can't use that measure of standard deviation because it will be massively understated, which massively overstates your Sharpe ratio. So you can't say, you can't use a Sharpe ratio. But if we use a Sharpe ratio, yes, I murdered the market. If we go with a pure return, I don't know yet. If we go with, wow, come on. I mean, you know what you're up. Just give me a rough number what you're up at this point in time. I have to do that in one of 2 ways. I have to do that with my full portfolio and not the stuff that's managed by other people, because I do have, if you want access to certain private investments, you got to get it through other investment firms. My full portfolio or my portfolio XGM. Portfolio XGM, yes, I had a great year. I had a good year because volatility was high and those premiums were beautiful, and I worked those premiums all the time. All the time, it worked out great. I said earlier in the year, I held on to GM far too long, and I had a position that was way too big. And as GM went down from 67 to 50, I thought, $17. And I had sold puts on the way, so they were put to me. Well, okay, the worst is over. And I was selling calls on them. But GM was falling faster than I could roll down the calls. So you're going to lose. That's the one problem with rolling down your calls on strategies, is if the underlying drops too fast. All the way to low 40s. And I can remember on YouTube at that time there was, I never really paid too much attention to Kramer, but the title of the video was Kramer bullish on GM. So I listened to it. And he had a call that came in saying, I'm looking at GM, and Kramer's like, oh my God, I don't think this can get any cheaper. I'd be buying it right here. So I thought, well, okay, well, good enough. That's what I believe too. Well, it fell to 40, which is its book value. 39 and change is the book value. I think, well, I'm here now. If I wasn't in it, I'd be a buyer. So I bought more, and it dropped, and I bought more, and it dropped all the way to 30. So I learned, you learn every year, you learn lessons. And the lesson there was something dirt cheap can get even cheaper, and it dropped all the way to $30. So full portfolio, less than zero, but I did still beat the S&P, but it held me down. However, S&P is not a good proxy for me because I invest outside of the index. The Mexican peso was just a beautiful return. The TLT trade I started at the beginning of the year, selling the 135 calls, was just a beautiful return. So they're not part of the S&P. So when we say, did you beat the market? Now we have to have a definition of, well, what market was I beating? So because I can invest outside of the S&P is not really a good benchmark to say I beat the market. And because I use a lot of options, the Sharpe ratio is not a good measure for what I used as well. So to determine whether or not I beat the market, we would have to devise a benchmark that matches the universe that I invest in, and then determine whether or not I could have beat a passive investment that matched as closely as possible what I was doing. That is brutally hard to do. So usually for the type of investing that I do, because it is macro, top down, sometimes bottom up, but everything is fair game, it's usually hedge fund style return. Your hurdle rates are usually 8%. I would say my full portfolio with GM, no, I did not. On that basis, I failed quite a bit. XGM, yeah, I'm in and around that performance level. XGM, in and around that performance level. So, it sounds like a simple question. Did you beat the market? But if I were your money manager, you would first have to say, well, what market are we talking about? Because you're all over the place. So, we'd have to first of all define a benchmark that's all over the place as well. Since you can't, there'd have to be some return hurdle. And if you're trading like a hedge fund, then you got to have a hedge fund hurdle rate. And if you are benchmark agnostic, which means you don't have a benchmark, that means you have an absolute return mandate, not a relative return mandate. Now, if I were being judged on that, I wouldn't have held GM as long as I did, because if I were managing somebody else's money, I would have bailed a lot faster on that one. So it sounds like an easy question, but it has such a difficult answer. Would you ever be concerned with not being diversified across brokerages? Do you think there are any dangers with having all of one's assets in IBKR, for instance? I have most of my money in IBKR and realized the other day there's really not a lot of trust, or is a lot of trust I have with them. Generally, I avoid having an amount over the government guarantee with one bank. How do you think about this kind of thing, and what your opinions on it? Well, you look for a custodian. And IB uses a custodian. So that means that IB does not actually have ownership, not even ownership, but I guess what would we say, access to your assets. They can send instructions on what to do, but there is a custodian in place. If the Fed was to hypothetically keep rates at an elevated level throughout this year, is it still possible for TLT to perform well? Yeah, it can perform to a certain degree. If rates were kept elevated for the year, here's the long end of the curve. In the long end of the curve is our expectations for GDP and our expectations for inflation. If it's elevated with no cuts, inflation expectations are going to come down, and the longer it stays elevated, the more that lower GDP and lower growth will be priced into the long end of the curve. through more rate cuts at the short end of the curve. So you'd get a curve that started to do this over time, so it could still perform, but the massive performance in TLT would come from a worst case scenario, which is more than a soft landing but a hard landing, and the Fed having to cut short rates. What are your thoughts on buying into stocks that have already shown strength, like oil stocks or insurance stocks, and looking for further momentum? Well, that is what momentum is, right? Is you buy past winners thinking that they're going to be future winners. Is if you have some belief that either the behavioral inefficiency that creates momentum or the continuing of the fundamentally good information that supports higher prices would continue. I know that you should take what the talking heads on Financial Channel with a pinch of salt, but some, who I normally quite like, are saying insurance companies and defense companies look great. Yeah, insurance companies, yeah. For momentum, technical, and well, I'm being harsh there with technical analysis. Let me wipe that out. With momentum, a lot of times it is a technical signal, because it is more of a behavioral issue. So sometimes fundamentals don't pick up momentum, whereas tech stocks look awful. In your housing trade, would you now consider buying underperformers like Lennar? Well, Lennar's not been underperforming. I don't think so. I have my charting here. Let me just call up Lennar. I don't think it's been underperforming. It's no, it's let's just look at historical graph for Lennar. No, if I look at a 1-year chart, I mean, it bottomed sometime in June in the mid 60s. It's sitting at 95.57. The last time it was at 95.57, you'd have to go back to early February. That for the last 6 months, Lennar has been doing quite well. I mean, going from hit a low of 65 in the summer. Even in the October sell-off, it only got to the low 70s, sitting at 96.57 for the last 3 months. It has been showing momentum, definite momentum. It has an all-time high sitting around 112, 113. And it's sitting at 96 right now. So, you really have to ask yourself, in the height of the housing craze, it hit 113 when mortgage rates were super, super low. Well, mortgage rates are 6% now. New home construction is way down. New home sales are way down. Even though it's the second largest in the U.S. and has good margins. Is it possible for it to hit all-time highs in an environment like this and take out the all-time highs from one of the better environments for home selling? This is the thing with momentum, right? Is you have to find momentum early enough and get in on the trend, but you must always be concerned that momentum can break at any time. What is nice about the home builders is they're not trading at anywhere near ridiculous multiples. They are trading at value multiples, so they could maintain this place for a while. I think I'd be more interested in Lennar on a pullback at this point. I think that home builders have significantly outperformed for the last quarter, and what more do you want? They can't keep going straight up. So that's the thing with momentum, is you see momentum. If you're late to momentum, you risk momentum breaking right when you're holding it. So you really got to get in on momentum early in the process. So if you have an ability to screen stocks for, which stocks have been hitting new 10-day highs or new 1-month highs, something like that. And when you see a stock repeatedly hitting, new 1-month highs over time, then there's something there that's early enough. But if you're looking for a 52-week high list, there are some stocks that are hitting 52-week highs. I think D.H. Horton is hitting 52-week highs. Lennar is not at 52-week highs yet. That's still a long ways from where the sell-off was. So you'd want a faster measure whatever, however you want to measure momentum, you'd need a faster measure of it. But Lennar has not been outperforming. In fact, if I want to look at Lennar, and I'll do it very quickly here, and if I want to look at it compared to the market, SPY, and we look at a performance chart of the two for, let's say, just a 1 year period, over a 1 year period, Lennar down right now, oh, that is the wrong one, hang on, SPY, let's get that in there. Lennar is down 4.46 based on a 1 year basis from January 7th of 2022 to January 10th of 2023. Lennar is only down 4.5%. The S&P is down 14.84%. So, yeah, it's been outperforming. It did underperform for quite some time, but all home builders did. But once it hit the lows in June, it was just an outperformer. If I look at a 6 month, Lennar outperformed the S&P easily for the last 6 months, up 23.79 versus up 1.37 for SPY. I think that was the end of the question. Where can we find the Tesla roll down series in the applied series course? Look for this icon, market updates. When you get in there, you'll have this folder here, which is all the ones that I put on YouTube. It's also available on the site for you, so you don't have to watch them on YouTube. And you'll see this new folder down here, market update extras, there within there. U.S. apartment demand turns negative for the first time since 2009. Do you think it's just a temporary correction, not a sign of an upcoming downturn trend? So this is kind of falls along the argument of let markets be what they are and you will fix inflation. The best cure for high prices is high prices. So if apartment rents are going up and up and up, at some point somebody looking at moving into an apartment may just say, it's simply not worth it. I'll stay home and move in with the parents or stay with the parents longer than they really should. So at the margin, it is going to affect decisions. So that the higher the price goes, demand will shift away from it to something else, thereby creating downward price pressure on the price. The best cure for high prices is high prices. This is just an example of the market doing its job. It would be, I think, inconceivable to think that higher and higher rents just have no effect on the demand for apartments. At some point, it's going to have an effect. All high prices at some point do have an effect. But all those people are going to, they can only stay where they are for so long. At some point, they're going to have to get out there. So as apartment rents start to tick down, they'll come back out. So I don't see apartment rents crashing. You might get to a point where, no, this is ridiculous. They'll moderate a little bit, and at the margin, they'll be picked up again. The apartment REITs I have are typically all Class A buildings. Class A usually has a fairly good tenant base. And the ones that I've seen that have reported earnings also report their vacancy rates. I mean, you're talking multi-year low vacancy rates in all of these. And some of the vacancy rates quarter after quarter actually decreased, meaning that there's fewer apartments available to rent. So it could be apartment specific, apartment building specific. It could be suburb versus city specific. It could be university and college town specific versus not university or college town. I don't have enough information on that, but if somebody said demand for apartments is decreasing, it would be like, well, at some point it would have to. At some point it would have to. You can't have prices just go in one direction without affecting demand. Is there any correlation between productivity and part-time and younger employees? Oh, I imagine there must be. I just don't know what it is. It is fair to assume the productivity would drop when the company now hires more temporary and younger workers. I ran a business operation before. My experience is that when we hire temps, They usually care less and not work as productive as we would want them to be. If that assumption holds, how would it impact inflation and the economy? Yeah, I can see the case for temp workers probably not having the same buy-in as an employee would, and probably not caring that much about your business as an employee would, because an employee's income is highly correlated with the success of the business, whereas the temp's income is highly correlated with the amount of time you want to keep the temp, and not really too concerned about the long-term success of your business. If they're there for a 2-week period and they know they're there for 2 weeks, you're not going to get a lot of buy-in from the employee. So it could be just, I don't know that I would say, oh well, temps are just lazier. There is a psychological component to the work, meaning, if you have buy-in where you are, you tend to be more productive because you care about the longevity of the very business that's giving you a paycheck. That's not always the case. Some employees don't care about that either. They just care about their paycheck without thinking that the long-term health of the business is directly correlated with their paycheck. I don't know. I don't know. I'm not a labor economist, and I never really cared to be. And I really didn't get into the literature, the labor economics literature too much, but I'm sure there are probably studies done looking at the productivity between these. Sometimes temps use temp agencies as a great way to introduce their skills to an employer that might not otherwise hire them, so that they start working as a temp, and they might overwork. They might be overproductive in the hopes that at the end of their contract period, which usually you can't hire a temp for about 6 months. It's part of the contract that you have, because you can't keep stealing the temp agency's employees. Usually you got to pay them at least 6 months on a contract before you can hire them. That if they're a standout employee after the temp period is gone, they may become a full-time employee. So you may get temps that outperform in hopes that they are going to get a full-time job out of it. So yeah, I'm not sure if there's that we can just say that there's a clear relationship that they tend to be less productive. I don't have an answer for that. How do you calculate the probability of each terminal rate scenario? I don't calculate it. I just read it off a chart. CME, Fed Watch Tool. And if you look in the description box for any of the market outlooks, you'll see the link for the Fed Watch Tool, and you'll get a chart with 2 bars. One will be the probability of a 25 basis point move, the other for 50. And if you look up here, it'll be February 1st. Well, all the months are here. Just go to June and click on June. Any thoughts on bond ETFs paying a double coupon in December than skipping January? They're not really skipping January. So let's take a whole year. There's January 1st. There's December 31st. And during the month of January, the assets will earn income, which is then paid to you in February. And during February, they'll earn income, which is then paid to you the next month. So your November payment is, your December payment is for the money earned in November. Well, December earns money, and usually you get it in January. But for accounting purposes, for year end, if you can, crowd it in at the end of the month with good forecastability about what that distribution is going to be, it helps with year-end and accounting purposes. And then for the next month, you earn money in January, you'll get paid in February. So you still get 12 distributions every year. I've just found out about covered call ETFs. Yeah, and there are indexes that each of these ETFs will track a particular index. If you go to SIBO, they have a whole bunch of index. One is the buy right index, which is a covered call strategy, and you can determine whether or not the ETFs track their index very well. And usually they have very predetermined rules about what they'll do. So they'll buy. It could be the S&P 500 buy right index. Which means that they'll be long the index, and they will sell calls on the index itself. So they might replicate it with long futures calls that are and because futures have a negative carry, you would be fully deleveraged, and you would have a treasury position which offsets a negative carry, and then you would sell 30 delta calls on the index. And since they're cash settled, you always have the cash to settle off those calls. So they'll have specific rules about how they roll their futures contracts and at what delta they're selling calls at. QYLD, I believe this is the NASDAQ 100. That's an ETF that has covered calls on the NASDAQ 100. Good addition to income-based portfolio. Yeah, but you can do it yourself. You know, like you can do this yourself. You don't need to pay the fees to get that done. You can do it yourself. If you know how to do it, you can do it yourself. Good yields, mostly monthly distributions, low beta, but limited growth. That's the trade-off, right? I didn't know such securities existed a few days ago, so I'm doing some research on them. Yeah, they exist. They exist. Sometimes a covered call strategy can outperform the market. Sometimes it doesn't. I believe QYLD sells at the money calls. So I think that they're always selling at the money. So if the stock moves up, they end up selling, the position gets called. Or, hang on now, if I remember the prospectus right, they sell at the money calls, but they don't allow the underlying to be called away. They cash settle it and they just open the next one at the money, wherever at the money happens to be. So you can have a whole bunch of cash losses throughout the year if the index just keeps rising because they cash settle it. You have to look at what the rules are for where they sell the calls. I have a question. I want to get your comment on what is called a no-risk security. In this video, T-bills. I'm studying for a security exam, and the chapter I'm on right now is talking about guarantees, performance guarantees. You can't make any performance guarantee. As an investment advisor, you cannot guarantee any performance for your client. That is true. U.S. government T-bills, nearly risk-free. Well, when we say the word risk-free, let's be clear what is risk-free. They are default risk-free. They are not interest rate risk-free or inflation risk-free. They are simply default risk-free, meaning that there'll be no default. So if you buy a 90-day T-bill, you can calculate, to 4 decimal places what your return will be if you hold it to maturity. But if you don't hold it to maturity, you don't know what your return will be, because if interest rates change, although the T-bill has very low duration, it still has some duration. There'll still be some price jiggling on the security, which will change your return. That's why you can't guarantee performance even for something like a T-bill, because it is a conditional performance. It's if you hold it to maturity on a pure discount bond, this is what you'll get. Let's see. Treasury bills and what is called guaranteed securities, which are backed by a third party like an insurance company. So here you're looking at something like maybe a segregated fund where they can guarantee performance. The most common guaranteed performance is a GIC. It's right in the name, right? Guaranteed investment certificate. And here your return is guaranteed. If it is non-marketable, it is guaranteed. So if you put $1,000 into a GIC for 1 year, it's locked in for 1 year at 8%, you will get $1,080. Your 8%, the bank is guaranteeing that you will get 8%. That is the bank's guarantee to you, because they will just give it to you. Now, they'll take your $1,000 and they'll put it somewhere else that's expected to earn more than 8%, but they'll guarantee you that you will get 8%. Will you comment briefly on U.S. T-bills versus guaranteed securities, and which ones you would say is more risk-free? Well, again, when we talk about more risk-free, what risk are we talking about? If you're talking about default risk, well, a bank can always default. So I would have to say at the margin, the government is more default risk-free. But if we're talking about interest rate risk in terms of performance, I think they're equal if you hold them to maturity. You can buy a 1-year T-bill or a 1-year GIC, and you can predict with certainty exactly what your return is going to be if you hold it to maturity. Now, if you don't hold the GIC to maturity, there is a penalty. So you can't guarantee that return if there's a penalty, but the bank will guarantee the return if you hold it to maturity. If the guaranteed security is more risk-free than the Treasury bill, but we use the U.S. Treasury bill when calculating our risk-free rate, you do use the T-bill when calculating your risk-free rate, because a bank GIC rate is not a market-determined rate, which means there is not an investment bank out there that can lend and borrow at the GIC rate. So that is really not the risk-free rate we would use to price derivatives. So when we think about pricing derivatives, we want to use a market risk-free rate. And that has to typically be a market-determined rate. A GIC is not market-determined, it is bank-determined, based on how much money they hope to draw into the GIC. That's about the best that I can say on that without reading exactly what you were reading to figure out the context. That's my best answer. Okay, this isn't really related to this video in particular. Level 3 CFA candidate without a degree looking to get into the industry. I've had this thought of doing independent fundamental analysis with real life companies, sectors to present to whoever could be interested in me or would be giving me a job opportunity to get my foot in. The applied series is a good way to start to enhance my learning and use it as a guide to help with what I'm looking to do. Sector, top-down, bottom-up analysis found on your website. So I don't want to just say, yeah, go ahead. I want to try to answer your question as honestly as I can here. Your goal is, it seems in your question, is to get into the interview room. Number one, you want to get into that room, and I guess you're not getting into that room. If you're getting into that room, I would say, I don't think that you need to spend money on the applied series to impress in that room. If you watch the market outlook I do every single week, you should be able to carry on a conversation in that room about interest rates, the shape of the yield curve, what implications that has. You should be able to talk about real rates, break-even rate. You should be able to carry on a good conversation in the bond market and in the equity market at a very high level. And that's what they want to see. I mean, if you're interviewing for a job and I see that you're a level 3 candidate, and during the interview I say, what do you think of the shape of the curve? Are you expecting more flattening or a steepening? And you said, I don't know. Oh, okay, that's curious that you don't know. Maybe rates aren't your thing. You think the Fed's going to raise rates 25 or 50 basis points at the next meeting? And if you said, I don't know, I would think, you don't know? How do you not know this? Clearly, this is not a passion of yours. You're not here because you're looking to build a solid career for yourself. You're here for a paycheck. And for that paycheck, you're willing to do some finance stuff. I'm not interested in you. If you're interested in a paycheck, I'm not interested in you. And in any interview you're in, I guarantee you're going to get a question like, so what's your best idea for the year? You better walk in there with an idea. You better have an idea. So if you're watching the market outlook every Sunday and paying attention to the market, you should be able to carry on a conversation. As far as getting in the room, well, that's a different story altogether. That could be resume related. It could be the country that you're in. I don't know what country you're in because CFA is global, so it could be the country that you're in. Opportunities may not be open in certain avenues without the degree that may be challenging. Maybe your job history doesn't align well with the type of job that you're trying to get. There could be something in your resume that's not getting you in the room. I don't know that having a fundamental analysis of a company done would really get that done. So I don't have enough information there to tell you or to give you any good advice on this other than your resume gets you in the room. Your knowledge of the market keeps you in the room and gets you the job. A level 3 should be getting you in a room. So maybe it's it's an issue with your resume. Maybe you need to speak with somebody who is more versed at how to make your resume look a lot better. And there are lots of, I think LinkedIn has a bunch of courses on that too, is how to make your resume stand out, how to make it better. You might want to start there first. Let's just go ahead and answer the question here, doing fundamental analysis with real companies. Pick a company. What do you like? You like casinos? Pick a casino. If you like retail, pick a retailer. If you like real estate, pick a real estate company. If you like data centers, pick a data center. If you like a tech company, pick a tech company. The way that you would start as a retailer or as a newbie to any company is go to their investor relations site. Don't go to the 10Qs and the 10Ks. They're meant for a very particular reader. Go to investor relations and look for any investor presentation that they happen to have. And in these investor presentations, they give you a nice view of the company. Usually it's a presentation centered around their last earnings, and they give you nice charts of what their growth is like over the last 5 or 10 years so that you don't have to dig through all of the statements to find it. Read through the presentation. Get a good idea of what it is they do and how they make money. And anything you don't understand, have a little notepad beside you and make a note of what it is you don't understand and try to Google those terms and see if you can't figure out what they mean. Then you're going to read the 10Q, well, actually the 10K, not the 10Q. You want to read the 10K because it has a lot more information in there. And read it. And I mean read every line and read it and make sure you understand everything. That's 8 to 10 hours of work to get all of that done, and you're making notes on the side, and you should have a very good idea of what this company does and how it operates, the divisions it has. You've been through the management discussion, you've looked at the high level results. You haven't looked at any income statement, balance sheet, or cash flow statement yet. You do that last because you're not going to understand those statements until you understand what it is that they do. Then you go through those statements, and then they have like every line on that statement then has a note. Note 1, note 2, note 3. You go to those particular notes and it breaks out that line into more detail of what is in that particular line item. And yeah, it is a deep dive. If you really want to get to know a company, oftentimes it's years of getting to know the company, and then you may know one company, but well, is it any good? How can you know unless you look at another company in the industry and compare it? Sort of a relative analysis. Then you got to learn something about the industry as a whole and changes in the industry. So it could take years to get to a level where you really know something, but you start somewhere. Once you get familiar with a company, here's what you'll notice, is you're going to be far more alert to news stories related to that industry and related to that company. Your eyes will just see it faster than anything else. So if you've been looking at home builders for a while and you're looking through your news feed, stories about home builders and new home construction, existing homes, they'll just pop out at you. And you'll start to read them and you'll learn more about the industry. You'll get a feel for what's going on. You'll know more and more each and every time. Once you're done with the investor presentation, once you're done with the 10K, and once you go through all of that, listen to the last earnings call. Now, on the earnings call for the first 15 minutes or so, they repeat, we did this quarter, we had this net income, which is a 23% increase over our income last year, our EBIT margin was this, or blah, 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 blah. But then the Q&A starts. And you're not going to appreciate the questions and the answers to the questions unless you've been through everything. And when you've been through everything and you hear a question, you go, oh, that is a good question. But you're not going to recognize it's a good question until you know all that stuff first. So if you're looking for, saying, well, how long is it going to take? 20 hours. That's too long. Well, that's just a beginning. How long does it take to become an expert in an industry? A lifetime. A lifetime. For the applied series course, could you display each week the main risk metrics that your portfolio has, such as dollar delta beta as a percent of NAV, theta as a percent of NAV, duration, etc.? I think this could help me understand more practically how to manage a portfolio with information gathered. It wouldn't, without context, they'd be meaningless numbers. So if I told you that my dollar delta beta was 3,500,000, which it is roughly around that amount, my dollar delta beta, that's signaling that I have positive exposure to the market right now. Well, what does that mean? Unless you know what my net asset value is, you're not going to know what that means. And that could change tomorrow. Tomorrow I could say, no, I got to bring it down. It could change easily with one trade. I could say, okay, well, this one's run about as far as it possibly can. Let's take half this position off. And if I do, my dollar delta beta will drop significantly. So to post something once a week is just not going to, it's not going to give you a picture of anything that I do. It'll probably be more confusing than anything else because it'll be out of context. So it's, I think I do enough with the market outlooks in terms, and I think I do a fairly good job of telling you well ahead of time of what it is that I'm doing and what I have exposure to and how I'm getting exposure to it, that to start to get really, really granular, unless I post my portfolio online for everybody to see and do live trades so that everybody sees what I'm doing. Oftentimes I'll have limit orders out for several hours at a time. I don't want you knowing what limit orders I have, especially when I'm trying to get some options in, because I don't want you jumping in front of me. I don't want such a competition for the positions that I'm trying to get. So, there's only so much I can do, but I get what you're saying. It's just that giving you anything without full context of what I have and what positions I have would almost be meaningless. So I'll pass on that. I'm a trainee investment manager. I have CFA level 1 under my belt, but since doing that off my own back, my company has decided that CISI level 7 wealth manager qualification was a better way to go. I think that's the chartered wealth management, right? Trying to remember this one. There's like 2 or 3 different things they have. The job is mostly relationship management. Yeah, wealth management is mostly relationship management. The PMs do everything with the portfolios. That's true. I place so much value on CFA, I don't feel as enthused as I would like to about wealth management qualification, even though there is likely a fair bit of overlap. I don't know that I'd say with level 3, especially the wealth management parts of level 3, there is probably some overlap. But level 2 is a valuation level. I doubt you're going to have that kind of exposure in the wealth management part of it. You may have some discussion of asset allocation, strategic versus tactical versus dynamic, that kind of thing. But I don't know that you would get into detail about valuing certain derivatives and valuing certain bonds, especially bonds with embedded options. That's a big thing. I also don't think that you'd be doing a lot of time series analysis and quant analysis there as well. So I don't know that there'd be much of an overlap with level 2, but probably some with level 3. Let's see. I want to sit myself down and analyze a stock. Oh, that's kind of like the same thing up here, but the task seems so daunting. I haven't attempted it in the 2 years I've been working. I have the applied series. I haven't watched it for some reason. There's so much friction for me. Well, there are 2 in the top. I've done agency, and I have done DHI. They're 3 to 4 hours long each, which, listen, they represent a lot more than 3 to 4 hours of work. It's you got to put in 20, 30 hours to really, really get to know these things, to put together a presentation that's 4 hours long. But it is a long process. And you're never done with it. Every quarter, you're going to read the quarterly statements, you're going to listen to the conference call, and you're going to see if anything changed from the previous quarter. Could you outline how long a first analysis should take and the rate of understanding I'm likely to get? You'll get to know a company very, very well in 20 hours. You're not going to be an expert. You're not about to do a 5-year cash flow forecast and calculate its cost of capital and calculate all the line items that it has. But you'll have a very good understanding of what this company does, how it makes money, and its 2 or 3 success factors and its 2 or 3 big risk factors. But over time, you'll start to get to know the company a little bit more. But you've got to follow it. Much like you can't just follow a sports team for 1 season and then expect 10 seasons from now that you know everything about that team, because its players will be different. You got to follow that sports team every single season. You know, who are the people they're bringing on, who's retiring, who's being traded, you know, who's the new coach, who's the the defense coach, the offense coach. All you have to follow the team every year. Well, it's the same with a stock, same with a company. Is every quarter it reports earnings. Well, that's the game. Are you going to watch the game or not? You can't keep skipping all the games and expect to know the company, right? So it is an undertaking. So, my advice to anybody is pick something you like. Pick something you're interested in. If you say, I hate insurance companies, I don't like the insurance business, hey, I'm going to analyze an insurance stock. Why would you put yourself through it? Why would you do it? Right? Pick something in an industry and a product or something that you can get into, and it'll be easier to follow. There we go. I have 2 questions. This is the last screen, by the way. Is there a place on IBKR where you can see futures price calculated for us? Wouldn't that just be the quote? Let's say we short ES June and we are wondering what the futures contract price would be if SPY climbs to 4,000. SPX. Okay, SPY. SPX climbs to 4,000. Well, if SPX was at 3,900 and it went to 4,000, your contract here would also go up 100 points. Unless you meant, well, what if it climbs over 3 weeks? Clearly, this is not going to go up 100 points over 3 weeks because some of the carry will wear off. Yeah, some of it will wear off, but no, I'm not aware of where you can project out what the price would be, but you can use... you can easily calculate it. Just take the index 3,900 multiplied by E. For R, you can use 4.3. Well, you'd have to use 0.043 minus, take off 0.019 roughly for the dividend yield, and multiply by the amount of time expressed in years. So if it's 3 months left, 0.25, you can get a rough estimate of what it would be. And then each day you're just taking, you're moving the 0.25 down, so it might be 89 over 365. Next day is 88 over 365. And here I would use the 3-month SOFR rate, which is about 4.3. You can calculate it, but I don't know that there's much value in doing that kind of stuff. Who cares what it's going to be? All you really need to care about is the terminal on expiration. So if the index is at 39 and you sell the June at 39.60, as long as the index stays below 39.60, you're okay. So if it goes to 4,000, the way I look at it is, well, I'm down 40. I don't care what the carry is. I don't care what the price would be because of the carry. That's going to fade away to zero as each day goes by. So I don't really care about that. That's money in the bag for me. I only care about the distance between 39 and where it happens to be. So, no, I don't know that there is anything for that because it's a linear payoff, and because it's linear, you could just add the prices or subtract them. It would be above the spot by the amount of the carry. I was wondering a trade station. You're thinking about another system. IBKR would calculate it for us. Not that I know of. You always enter a trade asking, what if I'm wrong? And have an exit plan. What is the exit plan on short futures if you're wrong? Well, it's a matter of why did I enter it? I entered it because it allows me to stay in my long positions longer. So if I was worried about the market being weak, I may not stay in my long positions as long as I would like to. By being short the futures contracts, it allows me to stay in my long positions longer. So if the market keeps going up, I still have positive exposure to the market, just not as much positive exposure as I would like to have. So I'm not going to be wrong in the sense that I'm looking at the position and closing it. I'm looking at why did I add it to a portfolio and what was my portfolio goal. So I can't be wrong with my portfolio goal, right? Simply close it for a loss. Well, you can continually roll over futures. You can continually roll them over. So let's say I shorted ES, 39.50 on June ES. And by expiration, the market is at 40.50. Well, then I would simply just roll over the next contract, and the next contract might be 40.80 because of the carry to get there. So I roll it over at 40.80. I got another pickup of 30 on this one, right? So while I was down 100 on this one, I roll it over to 40.80. You think you're taking the loss, but these are mark to market every day. So every day you were taking the loss. So it's not as if, I better take the loss. You've already taken the loss. The loss has already happened. So the mark to market means that by the time it ends at 40.50, there's a 100-point difference. So there's $5,000. That $5,000 left your account a long time ago. It left every single day. Every single day you're negative, that money leaves your account, so that when you close the contract, there is no loss to take. You've already taken the loss. So I'll roll it over to 40.80. I got a pickup of 30 points. So, the market was at 3,900. I use futures at 39.50. I'm just giving an example. And it went to 40.50. So it went up 150 points. I'm down 100. So I'll go ahead and I'll roll over to the 40.80s. Right? And let's say it gets up to 40.80. Well, I haven't lost anything and I picked up 30. So now I'm only down 70 on that, right? And you can continually roll them over. And if interest rates are high, you have a nice pickup on carry all the time. You're getting positive roll because the futures term structure for financial contracts is always in contango. So if you're buying, you have negative carry. If you're shorting, you have positive carry. With high interest rates, you have good positive carry every time you have to roll forward. And if I have a thesis that the market is inherently weak and is going to show up at some point, well, then I'm okay. I don't mind rolling them over and waiting. If I continually roll them over, that means the market is moving up. So are all my long positions moving up. They're just not, my portfolio is just not moving up by as much as it should move up. But at some point, I would say, the environment seems to have changed. Let me use some options to start hedging out some other things. But usually if I'm going to take a loss, it's because it's clearly obvious that I was wrong. And right now, I don't think being short ES on a portfolio level so that I can remain long on my other positions is inherently wrong. I don't manage positions. I manage my risk at the portfolio level. So let me just give you a reason why you should do that. If you have one stock, that's what you have. You have one stock. Your portfolio is the stock. Managing the position is managing the portfolio. If you add another stock that has a correlation less than 1 with this other stock, your portfolio risk, the risk at the portfolio level, is lower than the sums of the individual risks. So the existence of the second position already manages portfolio risk. So by starting to manage the individual risk of each is ignoring the fact that this correlation already reduces your portfolio risk. That's why once you start adding more securities to your portfolio, to account for all the pairwise correlations in here, because diversification lowers risk, to account for all the pairwise correlations, you really need to move your risk management to the level of the portfolio, not the level of the stock. By managing each of the risks of each and every single position negates the fact that the combination of those positions are already lowering portfolio risk. Why would you mess around with that? Then you'd only want to manage your risk at the portfolio level. So what seems like a risky individual position, seen in the context of a portfolio, may actually be reducing the risk of the overall portfolio, even though the individual position may seem like a risky position. You get what I'm saying? Think about it this way. Buying a ski hill is risky. Buying a golf course is risky. But if you buy a golf course beside a ski hill, that's not so risky. Because in the winter, they'll be skiing and you have one restaurant type location. In the summer, they'll be golfing. Well, you have the same restaurant location. You can share a lot of costs. So the combination of the two are less risky from a cash flow perspective than if you just owned a ski hill or if you just owned a golf course, right?